Alright, this is a video to walk through the sales and purchases of merchandise using the periodic inventory method. The periodic inventory method doesn't record any changes to the inventory account or to cost of goods sold during the accounting period. All that happens when we close the accounts at the end of the period. So let's look at this one first. We purchased merchandise from OLB Corporation for $15,000. The terms were 110 and 30, and it's FOB destination. Since we purchased it, that means that it won't become ours until we actually take possession of it at our destination. So we won't pay the freight on this. We're just going to debit purchases. And this is, let's make sure we highlight the differences. In the periodic method, we debit an account called purchases instead of the inventory account. So let's go look at our T accounts. And just to remind ourselves, it was a debit to the purchases account on July the 3rd and a credit to accounts payable OLB. So we're going to debit the purchases account, which acts as an expense account in the way it behaves. We're going to credit accounts payable to OLB Corporation, and of course mirror that in the general ledger account, accounts payable. So that's our first entry: a debit to purchases, a credit to accounts payable. Then we sold some merchandise to Brill Company for $11,500. The cost of the merchandise was $77.50. Credit terms 210 and 60. FOB destination. So since we're the seller, ownership is not going to transfer until it reaches the destination, which means that we will pay the shipping at that point when it gets charged. So here it is. This is the same entry as you would for the revenue in the perpetual method, which is debit accounts receivable Brill, credit sales revenue. So we're going to, on the 7th, we're going to debit accounts receivable Brill Company and credit sales revenue for $11,500. Here's sales revenue, accounts receivable, and accounts receivable Brill, making sure they get all the debits in there. So whatever's in the accounts receivable account, we mirror in the subsidiary ledger, and credit sales revenue. The interesting thing here is, since this is the periodic method, there is no entry that we have to make for the cost, because we don't, remember, this entry would be a debit to cost of goods sold and a credit to inventory. We don't make any entries in the inventory account, and we don't make any entries in the cost of goods sold account until the end of the period. So there's no entry needed for this guy. Makes it a little easier to do. Oops, let's get one more line in there. Here we purchase again from Rupert Company merchandise for $14,200, credit terms of 110 in 45 FOB shipping point. So we should pay the freight. We purchased it from them, but we take ownership at the shipping point, so we should be paying the freight when that comes due. We're going to debit again the purchases account and credit accounts payable Rupert for $14,200 on the 10th. So let's just do the accounts payable first, the credit to accounts payable. We're going to make sure we mirror that in the subsidiary ledger, and we're going to debit the purchases account for $14,200. Debit purchases, credit accounts payable, and mirror that in the subsidiary ledger. All right, the next one, we are going to pay $300 cash for shipping for the sale to Brill Company, and this was, we sold it to Brill FOB destination, and since we sold it, they're going to take possession of it at their destination. So we're just going to debit delivery expense, credit cash, the same as you would for the perpetual method. And finally, we returned, or Brill returns some merchandise to us from the sale of July the 7th. So here's the sale to them on July the 7th. They returned some stuff to us on the 12th. 5 days later, the cost of the merchandise was $1,450 when we sold it, and we sold it for $2,000. So the entry is going to be the same as you would do for the perpetual method. The revenue part of it would be debit sales, returns, and allowances, credit accounts receivable Brill for $2,000 on the 12th. Now that's the $2,000 is what we sold it for. This $1,450 is what it cost us. But look what happens. We're going to do sales, returns, and allowances. Same entry we would make in the perpetual method. And we're going to reduce their accounts receivable to us by $2,000. But I want you to look at this is the entry for the return under the perpetual method. We did the sales, returns, allowances, and accounts receivable the same, but we would debit inventory and credit cost of goods sold for the return of the inventory to our warehouse. In this case, there's no entry needed for the cost of goods sold. Again, if there's in the periodic method, if there's an entry to the inventory account, it's either to some other account like purchases, or it's not done at all. In this case, it's to two accounts that aren't used in the periodic method during the period: cost of goods sold and inventory. So we just ignore it. Okay, we talk to Rupert and Company, or they talk to us and request a reduction in the price of $1,200, or we requested a reduction in price. I'm sorry, we purchased it from Rupert here. We purchased it from Rupert, so we're going to debit accounts payable and credit purchase returns and allowances. Sorry about that. I had a quick phone call I had to get rid of. Purchase returns and allowances doesn't exist in the perpetual method. In the periodic method, we need this account in order to keep up with all the differences, the changes in the purchases we made. So we're going to debit accounts payable Rupert Company. And we're going to debit the subsidiary ledger there. And we're going to credit purchase returns and allowances for $1,200. Okay, let's do the next one. OLB requested that we pay the freight charge. Now, if you look up at the purchase from OLB, it was purchased FOB destination, so we shouldn't have had to pay the freight charge. So since we're doing that for us, they're just going to reduce the total cost of the whole thing by $200. It means we're not going to have to, we're going to pay the same amount. We're just, part of that's going to be freight for this guy. So we're just going to reduce the accounts payable to OLB by $200 and credit cash. Because when the time comes to pay it, they're going to say, okay, instead of paying the whole $14,200, now you just pay us $200, not $14,200. $15,000, just knock off $200 for what you paid for the freight for us, as a friendly gesture, just a way to make business work better. So debit accounts payable, $200. Also debit the subsidiary ledger and credit cash. Okay. And let's see, we received the balance due from Brill Company from the sale of the 12th, less the return on from the sale of the 7th, less the return on the 12th. And this is going to be the same entry that you would make under the the perpetual method. That doesn't change. Debit to cash for the net amount, debit to sales discounts for the amount of the discount that's allowed, and a credit to accounts receivable Brill. The way to do that is just to go over here to their T account and look at the balance. They have a $9,500 balance. So 2% of that, if you go back and look at the original purchase or original sale, was a 2% discount. 2% of $9,500 is $190. So we're going to debit sales discounts for $190, debit cash for $93.10, and credit accounts receivable Brill for $9,500. So there's our credit to the Brill account for $9,500. Let's mirror that in the general ledger. I'm going to receive the cash, debit of $93.10, and sales discount of $190. Debit $190, debit $93.10, credit $9,500. All right, we're through with the first page. The second page is next. Sorry to jump around on you. The second page is next. We're going to pay Rupert the amount that owed to them. And if you look at Rupert's account here, we owed them $13,000 after the purchase and the return. So we're going to debit their account for $13,000, and we're going to credit cash for the net amount that's due, and we're going to credit an account called purchase discounts again for the amount of the discount we earned instead of crediting the inventory account. So here it is, the debit to Rupert's account, the debit to accounts payable, and then the credit to purchase discounts and the credit to cash. Remember, in the periodic method, we can't use the inventory account or the cost of goods sold account, so we have to have something there to accumulate that information and then use it later when we close the accounts. All right, we sold merchandise to Brown for $11,000 under credit terms of 110N30, and I'm just going to go ahead and highlight the whole thing. The first entry is the same as it would be under the perpetual method. We're going to debit accounts receivable Brown and credit sales revenue for $11,000. There's the debit to accounts receivable and the mirrored entry in the subsidiary ledger. We're going to credit sales revenue for $11,000. Super simple. Now there's no entry needed for the cost of goods sold, so no cost of goods sold, no inventory entry here. Nothing happening there. All right. Brown requested a price reduction on the sale because the merchandise didn't meet their specs. So we're going to give it to them. This is an allowance and not a return. So we're just going to debit sales returns allowances and credit accounts receivable Brown. So here is the credit to accounts receivable Brown, the credit to accounts receivable, the general ledger account, a debit to sales returns and allowances. Same as it would be under the periodic method when there's an allowance. All right. Let me do one more line here. We received Brown's cash payment for the amount July the 1st, from the sale of July the 21st, less the price allowance. So it was $11,000 minus a $1,000 price allowance. Let's just look and make sure their balance at this point is $10,000, and that makes sense. So we're going to credit their account for $10,000. It was 110N30, so 1% discount, so we will give them a 1% sales discount and debit cash for the rest of it. So here is cash, a debit of $9,900. Here is the credit to the Brown account and the credit to accounts receivable. Debit to sales discounts. So debit sales discounts, debit cash, total of $10,000. Credit accounts receivable for $10,000. We paid OLB for the amount that we owed them. And this is going to be the same thing as you would under the perpetual method. We're going to look for OLB, make sure what their balance is. Their balance at this point is $14,800 that we owe them. So we're going to debit that account. We are going to credit cash for the gross amount, because this is out of discount. This was, if you notice, this was a purchase from July the 3rd, and it was 110N30, so we are outside the discount period, so there's no entry to be made for that. And that's it. That's how we do purchases and sales under the periodic method.